Segueing into the distressed market, Gregg, what are you seeing from the receivership side on CMBS distress in terms of the pipeline, kind of where we've come from, where we are today, and then kind of your crystal ball for the future? And everybody's looking for the deal. Is there still inventory out there, and will we see more of it?
The flow of assets has pretty much remained the same as far as volume goes, but just the makeup of the defaults is starting to change right now. 2009, 2010 were humongous for monetary defaults, meaning NOI just fell below debt service. Guys couldn't make the payment, so they went into default, and the lenders put the asset into receivership. But into 10 and 11, I don't want to say it slowed down tremendously, but it just got a little more not as rampant. And as we've gotten into the second half of 2012, now we're starting to transition from monetary defaults to maturity defaults, meaning that for whatever reason they've made it this far, the assets have performed, or the owners have fed them to keep them current, but the loan has come due in a maturity and they don't have the ability to refinance it. And for the future, that's going to be a much bigger story as you get into 2014. It'll increase in 2015, and it'll really increase in 2016 and 17. We sell a ton of assets out of the receivership estate. Chris has sold several for us. And to say that there's deals, I can't say that we've sold anything where either Chris or I or other brokers have looked after closing and said, oh my God, that guy stole that thing. The process that special servicers have to go through to basically get approval from their trust that they represent to sell an asset requires a humongous marketing campaign to show that it's been shown to the world, that everybody has seen it. There's been quite a long process. Buyers have been vetted, and it's very rare that we see something where it's a huge bargain price where a guy can pick something up. And that also plays on the fact that we've just seen, I'm sure as many of you have, a ton of equity capital that has been raised since 2009 for this time of assets coming out in a distressed scenario. The issue is that this much money has been raised, and about that many assets have been put out in the market. So you just have a situation simply where you have 3 to 4 times the amount of capital that you do assets available to absorb them. So what'll be interesting to see is, in my opinion, the next 18 months, because if there's a stabilization, kind of like there's been going now, and even any improvement, when that huge wave of maturities from 2014 to 2017, which is going to encompass over $600 billion worth of loans that will come due. If the market seems like it's improving or there's stabilization, I think those assets will start to have a chance at refi because they can bring in outside equity or some sign of joint venture deals or whatever they're going to do to try to make that happen. But if there's any hiccup in the next 18 months, it could be a real problem for all those assets, and that could be the first time where you see the amount of assets catch up to the amount of capital, because the amount of CMBS issuances, which we call CMBS 2.0s, anything after Lehman, 2009, 10, 11, 12, in the biggest year they've had thus far, it's been about $43 million. In the height of 2007, it was 225. So to do the same amount of loans and have that kind of volume, you can imagine how much additional capital will have to be raised to absorb those amount of assets when they actually come due. But like I said, the real question is how things go in the next 18 months and where capital is at that time.